consider flowers and bees. Flowers evolved as they do, bees evolved as they do. Somehow, the flower evolved in such a way as to contribute to feed bees. Bees evolved in such a way as to allow flowers to reproduce. Now, how did that come about if everything is a dog-eat-dog world? In fact, cooperation exists throughout the natural world, and sometimes it is amazingly complex, powerful, and effective.
This is the trader. This is how much money we made right here. And this is what it looks like on a chart. The chart on the left shows percent returns, and the chart on the right, the orangey line shows you the original equity, and the blue line shows you the value of the account over time.
Evolution is really fascinating. One of its key characteristics is its ability to create practical solutions that work in a manner that is beyond human comprehension. One of the first places this was put into practical use was in games. Because if you recall, there was a time when all human beings and animals in games moved in a very obviously programmed manner, very stilted, very robotic. Then suddenly, they became much more fluid, much more realistic.
This shows you exactly how this came about. So this is a company, this is its process in trying to evolve a controller for its artificial creations like people and animals. So generation 1, it falls down. Generation 5, it can sort of move, but not very well. And then later generations, so this is generation 10, you can see it can move a bit better, but still not very realistic. And then generation 20, it's walking really quite well. It's looking good. Of course, things got much better and much more realistic. So this is all evolved code. So no human being programmed this. Now look what the man who designed all this has to say about his own program.
Eventually, miraculously, you actually end up with something that works. The slightly scary thing is you don't know why it works and how it works.
This was soon used for all sorts of purposes. For example, traffic control, or designing escape routes from emergencies, or crowd control. Even the military use it for a number of purposes. Now, of course, this seems ideal. We have a tool that can create solutions beyond our ability to understand and is effective. Now, to make up an evolutionary system, you basically need agents. I'm going to call them people, just for convenience. And then you need these people to be different. They can't be the same in the same circumstances. You either need different people or different circumstances. And of course, if you have both, that's ideal. The second thing you need is an evolutionary force, something to drive the evolution. As I showed in the last video, it can be starvation, and we do have starvation in real society, but it also can be imitation. If the poorer agents are imitating the more successful agents, that will drive evolution even better than starvation. So here's the problem. We actually do have people who are different in different circumstances. We actually do have people imitating more successful people in an attempt to be more successful themselves. That means in society, we have evolutionary forces creating solutions, evolutionary solutions, that are beyond our understanding. Now, we are going to look at everything, including the big picture. But for now, we're just going to look at price.
Okay, you've seen this before. I demonstrated this when I was discussing inequality and the fairness of society. This is what I call the toy trader, and basically it's like this. There's a room, which is this square here, and in this room there's 400 people. Now, these people are first given 100 money, and they're given 5 toys. So all of them possess exactly the same thing. Now, when we start the simulation, all the agents or all the people, are instructed to do exactly the same thing, which is look for people with an arm length. So you stick your arm out and you turn around, and whoever you can touch, you then ask them how much their toys are. You find the lowest price, and whoever has the lowest price toy, you purchase one. Now this is your consumption. So as a consumer, you're consuming a single toy. Now, after everyone's purchased a toy, what your job is to maintain inventory. So if your inventory goes below 5, then you raise your price. And if your inventory goes above 5, then you lower your price. And then when you're done, you take a single step forward and then you repeat. That's everything that goes on in this simulation. Nothing else. Now, the model right now is set up so the inventory target is 5. And because they all start with 5 toys, that means there's no shortage and there's no surplus. Which means that based on this, the mainstream economic prediction is we'll end up with an equilibrium price of 20, which is 40,000 money divided by 2,000 toys. And that is marked on the price chart in orange. And you can see at the end of this run that price has gone there. It looks like mainstream economic theory 1, complexity economics 0. These are charts from university economics textbooks. And this is your classic supply and demand chart. You have the demand curve on that downward slopes, and then you have the supply curve upward slopes. Where they cross, that's where the price is determined, what's called the equilibrium price. Now this underpins all of mainstream theory, all of it. And let me just show you, this is another figure from a university textbook. This is the economy as a whole. Not all the detail, but as a whole, this is the economy. So basically you have households who are consumers, and then you have firms, which are producers. And you'll notice they're both linked on two sides by the supply and demand chart. The price of the goods and the price of the labor are both determined by the supply and demand chart. But here's the key, which a lot of people don't notice. Households are made up of people. Firms are made up of people. It's the same people. Especially when you look at the economy as a whole, like the whole world. That's why my toy model actually works, because their work and the consumption is taking place by the same people. What I've done is instead of asking the firms to maintain an inventory of 5, they're trying to maintain an inventory of 3. And that means that there's an overall oversupply and it's forcing the price down. This is exactly what neoclassical or mainstream economic theory predicts. Now in this section here, I've done the reverse. I've asked the firms to maintain a supply of 6. And there's only 5 available. So there's a system-wide shortage. And this has driven the price higher. And as you can see, it's sort of created another equilibrium price. Again, just as neoclassical theory predicts. Now we're going to do something you cannot do using a supply and demand chart. What we're going to do is we're going to have the individual agents change their strategy. So in other words, not all the agents are going to be the same. They're going to have a different pricing strategy. We're going to reset the simulation to a surplus condition. So the price normally would come down according to neoclassical theory. So what do you think is going to happen? Try and anticipate. Okay. This simulation is also done in a surplus condition, so normally price would drop. The agents start out identical, but then they slowly change. So we end up with a population of different people. Now, what's going to naturally happen when you have different strategies is some strategies are going to make agents wealthier than other strategies. What happens then is money starts accumulating in the wealthy class. The Gini goes very high indeed. And the poorer class starts getting knocked out of their ability to purchase. And you can see that in the number of trades. All this is completely invisible if you're using a mathematical equation-based model, as does all of mainstream economics and many heterodox economic analysis. In the real world, people imitate. They try to learn to do better. And what they look to, or who they look to, are people who are successful. So, for example, people who want to be successful in real estate, go to real estate courses or study people who've been very successful in real estate. Same with trading, pretty much any profession, you look to who's the best. And then you try to imitate them or adopt some of their characteristics in order to better yourself. As soon as you do this, you have evolution. Okay, before I show you the simulation, I want you to look at these price charts. So the first ones are assets, housing, and then the Dow Jones. And here's a list of antiques. They're all assets over time. And you notice they all just simply go up. Now look at these charts. These are from commodity markets. These are not assets. The vast majority of the traders here are simply looking to make money. So they don't care whether the price goes up or down. And look at the shape and how different they are from the asset classes. And now let me show you what happens when you introduce evolution to price. So what this simulation does is it ranks their agents according to how much money they have and the value of their assets. And whoever has the most is the top ranked, and whoever has the least is the bottom ranked. Then the lesser successful agents imitate the behavior of the more successful agents. And this creates an asset price evolutionary force. And what it does is it pushes the price upwards. What this suggests is that were the government to build many, many more houses, if the free market is left untouched, the evolutionary force will drive the price upwards, just as it has in every other single asset class. However, when we change the evolutionary measure of success, something entirely different appears. Keep in mind that supply and demand will not change in any way between these two simulation runs that I'm about to show you. Okay, so now this is a speculator model, meaning that I've changed the measure of success. The only difference between the asset class model that I just showed you and this one is that the measure of success is money only instead of money plus assets. There are no other differences. Their supply and demand is identical. The general agent behavior is identical. Everything's identical except for the measure of success. Okay, if you think about a speculator market, it is largely populated by traders who only care about money. They do not care about the price of the asset they're trading. They have no vested interest of whether it goes up or down. All they care about is that it moves. They catch the correct move because traders can make money. If they buy it, they'll make money going up. If they sell it, they'll make money going down. They just want to be on the right side of the price move. Now, if money is the only measure of success, what that means is you need price movements. Because if the price doesn't move, say you had an equilibrium price, for example, and the price didn't really shift, then no one could make money. And so you end up with an evolutionary force that wants to move the price upwards and downwards. So it'll constantly push it away from any kind of equilibrium that may exist. So what we will expect is an evolutionary force to arise that will constantly push the price around, either up or down, and you'll end up with a highly volatile chart that just chops up and down, up and down, up and down. And it might trend upwards, it might trend downwards, but there's no real drive the way there is in the asset class. Now, it is important to note that this is not an accurate model of the markets. In this particular model, there's a number of different price levels going on at the same time. In the real markets, everything's focused on a single price point, which is then reported. So this is not empirically accurate. However, what it has done is it captures the evolutionary forces based on the evolutionary prerequisites which are evident by observation. And these evolutionary prerequisites exist in the real markets, and they also exist in the models of the markets that are deemed successful. And they all exhibit this high volatility. So the key takeaway of what I've just shown you is I built a trade system with identical supply and demand, and then I implemented heterogeneous agents, so agents who are different with different characteristics. And then I implemented imitation. So the poorer agents were imitating the more successful agents. And it drastically changed the price pattern. Now in the short run, Supply and demand do impact price. So if there's a shortage, price goes up. If demand suddenly goes up, price goes up. If, the opposite, price will go down. And this has been observed over and over again. However, in the long run, there are other forces at play. I'm not talking about the short run because it's very obvious that supply and demand move price in the short run. But in the long run, depending how the system is set up, we get vastly different outcomes regardless of supply and demand. Okay, this is all I want to show you today, and I hope you enjoyed it, and perhaps see you next week.